The S&P 500 index, the benchmark for the US stock market, has surged right back to all-time highs after a couple of months of consolidation. And already we see euphoric sentiment coming back into the mainstream media. Artificial intelligence, easing inflation, strong earnings, Donald Trump pushing for cheaper oil. According to them, the bull market is supposedly back stronger than ever. We've been riding this bull market over the last couple of years with some pretty incredible trades at Bravos. But now as the stock market is making a new all-time high, we have reasons to suspect that Wall Street is about to pull one of its favorite tricks again. The key to success in trading financial assets is to know when to start getting defensive and bet against the popular narratives that you see on mainstream media. As the S&P is making a new all-time high here, the number of stocks actually participating in that new all-time high is at record lows. We can see that on this chart that shows us exactly the percentage of stocks that have been moving higher over the last 200 days. Only about 60% of stocks within the S&P 500 have been trending higher over the last 200 days. That is a lower number of stocks trending up than we saw at any point during 2024. So we can effectively say that underneath the surface, this is the weakest stock market in over a year, which is not really something you want to see when the S&P 500 is making a new all-time high. If we rewind to early 2022, we actually saw something quite similar. As the S&P 500 made a new all-time high in January of 22, we see that the number of stocks that were trending higher as that was happening was the lowest in over a year. Back here, that was followed by the 2022 bear market that took the stock market down by 25%. Now, I want to be clear, we're not too worried about seeing another prolonged bear market like we did in 2022. Back then, you had a Federal Reserve that had to raise interest rates very rapidly from 0%, and we had oil prices back here that were skyrocketing in anticipation of a war in Ukraine. None of these forces are present today. Inflation is low and stable, mainly because all of the stimulus money from COVID is now completely gone. The Federal Reserve is looking to keep interest rates at around the same level, and oil prices are at exactly the same level they were at a year ago. This is the perfect cocktail of conditions for the stock market to continue rising, but in the short term, there is one possible catalyst for the market to move lower, and that is a rising US government bond yields. Now, you might be thinking, how on earth can US government bond yields impact the short-term performance of US stocks? This is something we talk about a lot on this channel, and it's simply because stocks and bonds historically make up the majority of US investors' portfolio. Government bonds guarantee that you will get your money back with interest when that bond comes to maturity. For instance, a 10-year bond that has a 2% interest rate guarantees investors that they'll get a 2% return on investment every year over the next 10 years. Now, that may not sound like much, but imagine all of a sudden that yield jumps to 5%. Well, that's already a little bit more interesting, and it can lead investors to increase their exposure to bonds and reduce their exposure to stocks. This is why stocks and bonds are incredibly interconnected. And if you've been watching our recent videos, you'll know that the 10-year government bond yield has been rising significantly over the last few months. Now, not nearly as much as it did in 2022, but enough to make investors reconsider their allocation to stocks. The last few times that bond yields rose this much, it coincided with some pretty violent corrections in the stock market. And we happen to think there's a big risk of one more thrust up in bond yields that could pull the stock market down. Now, I want to be clear, we don't have a crystal ball. All of our analysis on market breadth, bond yields, commodity prices, economic data, all of that gives us certain odds of something happening, which we can base our trading decisions on. If all of the lights are red, the odds of a market decline are high and we get very defensive or even bet on the market going down. If all of the lights are green, the odds of the market rising are high and we get more aggressively long. Today, the lights are yellow, so we still have long positions on the stock market, but we've booked profits in some of our positions. We booked a 19% profit on GEV, a 21% profit on Arista Networks, and an 18% profit on Talon Energy. These three trades, by the way, were made just in the space of a couple of weeks, really showing you the power of picking the right trades in a strong bull market. So as the market is hitting new all-time highs and mainstream media is getting excited about the bull market continuing, we're getting a little bit more defensive right now. We favor exposure to gold and large cap stocks like Amazon and Alphabet that we still have trades on because we think these two parts of the market could actually be very resilient in a short-term market correction. Building some cash today can allow us to have buying power when the market corrects to ride the next leg higher. here. If the market doesn't correct, we'll be waiting for the warning signals that we discussed in this video to clear up and ramp our exposure back up as soon as that's the case. If you want to follow all of our trading decisions, our buy and sell alerts, go to bravosresearch.com and subscribe to our website. You won't regret it.